Page 3 now. The Federal Reserve is making it more likely that it will not be ready to raise interest rates until at least September. In fact, traders are now betting December will likely mark the start of the rate hike cycle. In a statement after Wednesday's meeting, the Fed took out calendar references and pointed to decisions being data dependent. The Fed also took note of the sluggish U.S. economic growth during the first quarter.
The core inflation numbers have transited through the down move from lower import prices and more so from lower energy prices. They're already beginning to show a little bit of a lift. And it will be very difficult for them to say, I think, in June, that they're not seeing a trend that says we're getting back towards 2% over the medium term and that they could have reasonable confidence. The hard part of that, or the conundrum, so to speak, to use a lot of the language they like to use, is that while that might be going on, the economy really is going to be still stuck at a rather mediocre rate of growth. The unemployment rate probably is still in that 5.5% range and not really making tremendous progress towards much lower numbers.
The Fed's decision means it will keep its key rate near zero, where it's been since December 2008. That's when the central bank slashed the rate as low as it could to support an economy headed into the deepest recession since the 1930s. Joining me now, president of Wilsey Asset Management, Brent Wilsey. Thank you for coming, Brent.
Sure, thanks for having me.
The jobless claims were 262,000, which is well below the estimate. What impact is that going to have on the community?
Well, that's going to happen, Wendy, and I just listened to those commentary about, the Fed's not going to raise rates until maybe December now. This can kind of change that because the lower jobless claims of 262,000 below the estimate, and last week it was 296, and I got to point out, Wendy, this is the lowest since April 2000. So this is a very, very good number showing there is some strength in the economy. So this is going to change. You're going to have more people, I don't know about you, but I go to restaurants and on the freeway and so forth. They're always packed. We're going to see more and more of this, and we are going to see the economy turn around. Now, what is happening in the country is there are weak spots. But right here in Southern California and other parts across the country, there's some very, very strong parts that are really giving some good balance to the economy.
Brent, I want to talk to you about personal income. So personal income was flat in March, and a month-over-month comparison says consumer spending is up 0.4%. What does that mean in practical terms?
A great question, Wendy, because people look at it like, well, how can people spend more when their income was actually flat? And we got to remember this is month over month. So the wages just didn't go up for people. They didn't earn any more this month than last month, but they spent more. And how can you do that? Well, one way they did it is that gas prices are lower. And for a while, people were putting that gas money into the bank. Well, now they're getting used to it, and they're starting to spend it because they feel comfortable that gas prices aren't going to turn and go right back up. So they're spending that. That's important because that helps the economy. Consumers account for about 62% of the GDP. So if they're spending more, that's helpful. And if we look at longer term, year over year, personal income is up 3.8% and spending is about 3%. So we're on a decent track there, and that is helpful to see that in the economy.
And let's talk a little bit about inflation. How would you characterize the trends in that arena?
And again, just hearing from that commentary before mine, that inflation is low, and it is low. Right now, year over year, it's up about 1.4%. But this is going to change going forward. I can't tell you how quickly, but I don't think it's going to be too long because gas prices are starting to rise. More people are getting more jobs. They're going to be spending more, and it's a supply-demand factor that causes inflation. So if the supply is declining because demand is increasing, that's going to put prices up. If people have more jobs and they're working more, they have more income, they're going to buy more products. Gasoline going up prices, that's going to put inflation up. So I think we're going to have more inflation going forward. Probably we'll start seeing some signs, I think, the next couple months or so.
Okay, let's turn a little bit to the GDP, which was disappointing, coming in at 0.2 when the expectation was 1.0. Can you first break down what that means and then how that's going to affect us?
Definitely, Wendy. And I want to point out, too, that and I think for the last 20, 25 years, the first quarter GDP has always been bad. So we can't get too excited about this saying, oh, my gosh, the economy is terrible. What it means is that the estimate was at 1%. It came in at 0.2. That's a growth in the economy. This is the gross domestic products of all the products and services growing in the economy. So how is our economy doing? Well, Well, it doesn't look very good. I didn't think it was going to be this bad. I thought it was going to be maybe 0.5, maybe 1%. But what happened, one thing I knew was going to happen, the strong dollar, that hurt the exports. If our exports are more expensive, they're not going to be, foreign countries are not going to buy it because they're too expensive. The other thing that hurt was the bad weather again from last year back east. Bad weather, people don't go out in the weather to go consume. They want to stay in the house and be warm and be dry. Thing I didn't think about was the West Coast port strike. That kind of backed things up a little bit to where products weren't moving. And then lastly, the energy companies, because they are pulling back on their capital spending, that hurt the GDP as well. So looking forward, I don't see this in the second quarter. And we do not have a robust economy. We're not going to have a 5% GDP. But I think in the second quarter, we could see 2 to maybe 2.5% GDP, a fair growth in the economy.
You know, Brent, given some of the factors that you've mentioned, including, acts of nature, is there any good way to make this kind of prediction going forward?
Well, things I look at, too, I mean, today we have the Chicago Purchasing Managers Index came out today, came in at 52.3 versus last month 46.3. And what I saw, Wendy, was new orders surged up 12.8 points to 55.1. This is the biggest jump in more than 30 years. This is a huge thing for the economy because people are ordering more. Backlog orders were up. So there are some good things going on, and that's why looking at all this data, I look at every single day in the economy, you take all this together, and you start getting a good estimate of what things can be at. And I'll never say, oh, it's going to come at 2.25. Who knows for sure? But I know I'm very confident the second quarter will probably be around 2 to 2.5%, unless there's some changes, war or something else that changes things. But the second quarter, we'll be happy. We're going to talk about that probably in July or so.
Great. Thank you so much, Brent, for joining us.
You're welcome.